Hi guys, welcome back to my channel. Let's talk about what are the legal risks to cryptocurrencies investors. Along with the explosion of interest in cryptocurrency, there's a growing need for clarity regarding the legal implications of these new currencies and the technologies that drive them. Regulatory agencies, tax authorities, and central banks around the world all are working to understand the nature and meaning of digital currencies. Meanwhile, the individual investors can make a great deal of money investing in them, but they also assume central legal risk when they buy and sell cryptocurrencies. Much of the murkiness of the legal standing of cryptocurrencies is due to its newness relative to more traditional currency and payment systems. What are the key takeaways? The regulations of cryptocurrencies remains in an unsettled state. The wise cryptocurrencies investors should consider reporting their holdings as foreign assets, although the requirements remain unclear. One fact is definite. Profit in cryptocurrencies trading are taxable as capital gains in the US. The lack of a centralized authority can be a legal and financial risk to cryptocurrencies owners. Cryptocurrencies and taxes. One of the most critical legal considerations for a cryptocurrencies investor has to do with the way that government tax authorities view cryptocurrencies holdings. In fact, their views are evolving, and cryptocurrencies investors need to keep an eye on their latest pro announcement. Capitals gains and cryptocurrencies. In the US, the IRS has defined cryptocurrencies as property rather than currencies. This means that individual investors are subject to capital gains tax laws when it comes to reporting cryptocurrencies profit and expenses on their annual tax returns, regardless of what they purchase digital coin. Note that the above is true for investors who buy and sell cryptocurrencies. If you are an employee and receive cryptocurrency as salary, it is taxable as income. The amount is based on the value in the US dollars of the cryptocurrencies at the time it was paid. Cryptocurrency and foreign bank account regulations. Cryptocurrency trading frequently involves holding cryptocurrency in a foreign account. As of January 2022, the federal laws does not view a foreign cryptocurrency account as a type of reportable account. That is, cryptocurrency account holders are not required to file disclosures of their foreign accounts to the Financial Crime Enforcement Network, an agency of the US Treasury Department, commonly called an FBR for Foreign Bank Account Report. This is FinCEN Form 114 and it must be filled by holders or substantial overseas accounts. Cryptocurrencies wallets are not included in that requirement, but that could change at any time. FinCEN intends to propose amending the filing requirements regarding foreign bank accounts to include cryptocurrencies holding. Cryptocurrency and the IRS. IRS Form 8938, known as FATCA, is the tax agency's version of FinCEN and FBAR. Taxpayers with substantial assets in foreign accounts are required to file these statements of specified foreign financial assets as well as the FBR. As of January 2022, the IRS has not definitely ruled on this subject. The questions of whatever cryptocurrency wallet owners must report their holdings using Form 8938 is unclear. Blogs for lawyers, accountants, and cryptocurrencies investors are awesh in their debate over whatever a wallet is a financial institutions or whether the IRS think it is. A common piece of advice comes from a blog run by Blockpit, which specializes in cryptocurrencies tax compliance. Given the severe penalties for failing to file an FBR, a if ATCA or both owners of cryptocurrencies wallet should file from both. Infractions are punishable with a dollar fine or half the account value and criminal penalties as possible. At the very least, consult a tax professional who has some familiarity with cryptocurrency when it comes to file your taxes. Cryptocurrency's decentralized status. One of the greatest draws of many digital currencies is also a potential risk factor for the individual investor. Cryptocurrencies, by definitions, are decentralized, meaning that they have no physical presence and are not backed by a central authority. While governments around the world have stepped in to assert their regulatory powers in various ways, BTC and other digital currencies like it remains unattached to any jurisdictions or institutions. On the other hand, these frees investors from being beholden to those institutions. On the other hand, the status could result in legal complications when there is no central authority. The value of digital currencies is dependent entirely upon the value that other owners and investors ascribe to them. This is true across all currencies, digital or fiat. Without a central authority backing the value of a digital currency, investors may be left in the lurch should complications with transactions or ownership arise. Another potential risk associated with cryptocurrency as a result of their decentralized status has to do with the particulars of transactions. In most other transactions, currencies with a physical presence changes mind. In the case of electronic transactions, a trusted financial institution is involved in creating and setting deposits and debt claim. Neither of these concept applies to cryptocurrencies transaction. Because of this fundamental difference, legal confusions between parties in various types of digital currencies transaction is a real possibility. Once again, because of the decentralized state of these currencies, the path of the legal recourse in these situations can be difficult to access. Cryptocurrencies registrations and license. A growing number of business are taking digital currencies as a form of payment. 20 payment in 2022, you could spend your Bitcoin at Microsoft Xbox Store, Home Depot, and Whole Food. As in other financial areas, business may eventually be required to register and obtain licenses for particular jurisdictions and activities. However, due to digital currencies' complex and evolving legal status, this area is significantly less clear for business operating in the cryptocurrency market. Companies that only accept cryptocurrencies, for example, may not need to register or obtain licenses at all. On the other hand, they may be required to submit to special considerations depending upon their jurisdictions. The onus of responsibility falls on business owners and managers to ensure that they follow proper legal procedures for their operations at both the local and state level. For example, at the federal level, financial institutions must maintain certain protection activities against money laundering and fraud. The transmissions of frauds are more. Considerations like this also apply to business dealing with the digital currencies. Fraud and money laundering. There is a widespread belief that cryptocurrencies provide criminal organizations with a new means of committing fraud, money laundering, and a host of other financial crimes. This may not directly impact most cryptocurrency investors who do not intend to use this new technology to commit such crimes. However, investors who find themselves in the unfortunate positions of being victim of financial crime do not likely have the same legal opinions as traditional victims of fraud. This issue also relates to the decentralized status of digital currencies. When a cryptocurrency exchange is hacked and customers holding are stolen, for instance, there is frequently no standard practice for recovering the missing frauds. Digital currency investor thus takes on a certain amount of risk by purchasing and holding cryptocurrencies asset. That's all. Thanks for watching. Stay tuned for my next video.